Alrighty, this is Chris from MarketSwingTrader.com. Well, we are going to go over diagonal spreads. Now, what is a diagonal spread? It's the simultaneous selling of a call or put at a different strike price and different expiration date. Okay, that is just a simple definition of diagonal spread. Now, what we are going to look at, I'm looking at Union Pacific, UNP. Now, this is only an educational video. It's not an endorsement to purchase any stock or option. It's only for educational purposes. Make sure you consult a licensed financial advisor before investing any real money. And like I always say, paper trade. Paper trade so you can understand how options work, how the four Greeks work, how they affect your positions, how the swing in the markets and the stock or ETF you're in affects your position. So always paper trade. Now, let's look at UNP. UNP. Okay, so let's say you did a scan and you're looking through, and what I normally do is I like looking at the S&P 500. Okay, I've got certain scans that I like to run, and I only like to really look into good quality stocks. Now UNP is a good quality stock, so well, that's just my opinion. So I'm looking through, and let's say I find this. Okay, we had a nice little run, but right now this is December. These are Persons pivots. Now I like using Persons pivots. Now the December pivot is right around 109.99. Let's just say 110. And these three lines, this is the linear regression tool in Thinkorswim. Okay, so the top of it is, let's say, right around here at 112. And the stochastics, I use the full stochastics set at 80, 20, 14, 3, and 3. So the stochastics is overbought, so it looks like we could have a slight pullback. But then again, the way that this market is, I mean, we could have a major pullback. I mean, we could have a sell-off in the stock like we did here because we were thinking we were going up and we just got slammed down. I mean, it does happen, okay? Sometimes I get into a trade and it's like, okay, I'm slightly bullish on it, and then it just gets clobbered on the trade. So I want to limit my risk, okay? Define your risk. So that is what professional option traders like to do. They define their risk, okay? So they know when they get into a trade, they already know the risk, okay? So let's say I'm looking at the resistance levels here. So let's go over and look to put on a trade, okay? So I'm going to look at January and February. So let's look at January. Now, let's go ahead and put on a diagonal. So let's say we are going to sell in January. We're going to sell the 115 strike, collect some premium, but then in February, we want to make sure we have a little insurance in case we have a blowout rally and it goes way up to like 150, and we don't want to be naked. We don't have a naked call sitting out there, okay? And plus this is diagonal spread. Okay, so that is a diagonal spread. If we look at the risk profile, as you can see, my defined risk is $504. Okay, if we have a blowout rally, we go way up, that's the max that I can lose, $504. Okay, so now if we have a major sell-off, okay, let's say we're trading right here at 102.69. Let's say we have a big sell-off all the way down here, down to like around $80. So we have a major sell-off and we lose 20 points on this thing, and we go all the way down to $80, way down to here. What is my max loss? My max loss is $4. Right there, $4. Now let's say I want to mess around with these. Okay, but actually let's go back to the Thinkorswim platform. This is why I like Thinkorswim, because they just get it for option traders. We're looking at the 115, so what we're going to do is we're going to right click and we're going to buy a diagonal. As you can see right here, right now we got a debit of 1 cent. 1 cent debit. So we got a 1 cent debit. We're going to put this on. Now if we sell all the way down here to $80, max loss is $1. $1. That's your max loss. Plus, well, commissions. So this is a diagonal spread. Now what I'm looking for is, let's say we go up here to about 110, 112, and we have some resistance, and let's say we pull back some, and right at expiration, because it's going to expire in February. Let's say at expiration we expired between 110 and let's say 115. Okay, so we could make a pretty decent profit if we at expiration. If we close at 110, profit would be around 40 bucks. If, ideally, if we close around 115, you get the total max profit of around 130. Okay, now these are diagonals. I kind of use them sometimes instead of calendars, because sometimes when you put on a calendar, let's put these at the same strike prices at 115. Okay, sometimes you put on a calendar and all of a sudden you completely sell off and you lose money. That's why I kind of like these, because if we have a sell-off, you don't get clobbered on the trade. Okay, and this I think would be a pretty decent trade, because when I'm looking at diagonals, I'm looking to either break even or even make a little profit. Now, if you're willing to go up even a little bit more, up to, let's say, 125. Okay, of course your risk is higher. Okay, now it's $968. Your risk is higher. Okay, and if we close around 110, your max your profit would be around $41. But also we completely sell off all the way down to $80, then you would still make $32. Okay, so the thing is, you just have to mess around with these numbers and what you feel comfortable with. Okay, and try and get a range. And this is a theta positive position, because theta, we're collecting 47 cents. So as time passes on, time decay, you are collecting money, as you can see from the P&L and the theta. Okay, it just keeps going up. Okay, and then all of a sudden it expires. Let's say we're at 110. Okay, so that's positive theta position. Of course, right now we're at negative 62 cents, but let's go ahead and reset these slices. Okay, so that is the trade, a diagonal. Now let's look at a different one. Let's look at IBM. Okay, if we look at IBM, okay, let's say we're around 197 for the resistance pivot. Let's say at 200. We want to try and go to 200. Let's say we don't think we're going to go above 200. If we do get there, we're going to probably pull back slightly. So let's try and put on a diagonal trade for this. The first thing I look at that I don't like is January, and then it flips over to April. And also the implied volatility, we're at 24.8 and 27.1. So if we go to the risk profile, we go to January, let's say we do 200, so we're going to buy a diagonal. We look at the risk profile, as you can see right away, it's not looking too good. Okay, even if we go up to 110, you know, it's still, you would be losing around $100 if we completely sell off. So, I mean, this is not an ideal position. Okay, in order to really make a profit, you would have to, at 215, even if we sell off, of course, if we close around 200, this is your break even right here, around 204. Okay, even if we sell off, you know, you're not going to get clobbered. But then again, look at the spread. You got 200 and 215. That's a little high. I normally just like going up 2 or down 2 when I'm doing options, and just play around with the numbers. So if we sell off, you're still going to be losing money. So, but the main reason for that is if you look here, you're in January and then all of a sudden it goes over to April. That's just not an ideal trade for me for a diagonal, because I either want to break even or make a little profit if we get clobbered on the trade when you totally sell off. So that is diagonal trades. Make sure you paper trade with them. Just get a feel for them and see if it's just another tool you want to put in your toolbox with option trading. Thank you.